A couple of months ago on our podcast, the Playing Footsie podcast, I had the opportunity to talk to a man called Sven Carlin. Sven is one of the most popular value investment YouTubers on the internet. He's probably the biggest out there. And that podcast is ridiculously long, but it's full of so much good information. So what I decided to do was I thought I'd break it down on here and show you the highlights of my conversation with Sven Carlin. We go through loads of things. We go through talking about investing with kids, investing in the market, beating the market. He's a big believer of that. He'll let you know exactly what he thinks.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.
Yeah, today we've managed to get Sven on. So I'm just going to ask him a load of questions because I want to know everything about you, mate, and I want to know where you started investing. In fact, let's just get started. How did you get into investing, and why did you start?
So I was born in the former Socialistic Republic of Yugoslavia, where a stock market didn't even exist. So then we had the war and things like that. And then stocks, and actually a stock exchange only started somewhere in 1998. And as you had something called privatization, where all the big companies were given to all the population, my parents got some stocks. And as soon as they got the stocks, they sold everything. But I kept following the stock prices, and I saw that if they would have waited 6 months, they would have doubled their money. If they would have waited a year, 2 years, they would have tripled their money. And then I said, wait a minute, there's something with the stock market that there must be something good. And then I started reading some books. I think the first book I got my hands, I was about 15, 16. Despite whatever says about Robert Kiyosaki, the first book, Rich Dad, Poor Dad, was one that I got in my hands. And then there was something about the stock market. He said he bought something for 5 and sold for 15. And I got hooked and I started researching businesses. But I was immediately not the Kiyosaki gambler or something like that, but I was an owner of businesses. And my dream was to be financially free. I wanted to have $1 million invested, 5-6% growing dividends, and simply be financially free. And that's how I started back in 2001, I think. So I'm 20 years in now.
Was there any reason to do with the tech bubble as to why you started investing at that time?
Ericsson, Nikola Tesla is a tech company because it provides all the things to 2G, 3G, 4G, and now 5G. And they go to all these countries to install all these systems and internet and everything. So it was a tech stock. But when stocks go down, everyone is selling. And 51% of the company was owned by employees. And they were all selling in panic because it's, when stocks go down, everybody's selling no matter the value. And if you can find the value, which I thought 33% dividend yield was value, then you can find your 10x stocks easily.
And I suppose when it's quite heavily employee owned, those investors, because they probably wouldn't be investors as such because they're employee owned, they don't understand it as well as somebody who purposely went out and found the stock,
Especially everybody got, I think it was 100 stocks for nothing. So It's just something that came, if I sell my stocks now, I can buy a car. And we just exited war, communism. So it was really a lot of money they had. And everybody was selling just to buy something. And then when the stock started to go down because of the dot-com crash, everybody was selling in panic. Let me sell as long as I have something.
Wow, that's a really interesting one. Do you remember at that time? Because this is what I'm trying to find people who were investing at that time, because I'm quite new to investing. I'm one of those new ones. You probably hate me because I'm sort of the new money to the investing. And just kind of having a go sort of thing. But I've spoken to some investors who were around then and around 1970s as well. What were the thoughts and what were people saying back then? Because a lot of people were saying back then value is dead and all those sorts of questions and all those sorts of sayings. And is it the same this time? Are you hearing similar things to this? Was there a similar feeling in 2001?
So as when there is a bubble, like everyone discusses stocks, everybody investing, everybody is looking at something. And then when things crash, everyone shuts up. It's absolute silence. I remember in 2007, we had the forum on a local market, and it had about 20,000 daily logins, 20,000. In 2010, it had about 10 daily logins. So when when stocks go up, everyone wants to play the game. Everyone is a genius in a bull market.
Yeah.
When stocks crash, nobody wants to talk about stocks. And if you mention stocks, everybody will run away from you. And that's the best time to buy, of course.
What is your goal with investing and how far are you from it? And what do you want to achieve with investing?
So when I started investing, my goal was, okay, I want to reach 1 million. I want my dividends and I want to be financially free so that I can go fishing, that I can do whatever I want.
Yeah.
And I reached that very early. I think, as I said, a 10 bagger here, 43% dividend. I reached my financial freedom by 2006, let's say. But then I figured out it's a limited financial freedom because you have to sit tight. That's your funds. You cannot sell anything. You cannot. But then I said, okay, maybe I'm too young to retire. So in 2007, I sold everything, all the stocks. So that was luck, but also my stocks went up 10 times. So I sold everything. And then I bought a boat to enjoy diving. I paid for my PhD. I finished school, I found a job, started learning. Then in 2009, I invested heavily again with everything I had. 2013, sold a lot because we wanted to explore the world, move to England, learn a new language, and see what we are worth. And so it was mostly with stocks up till recently, it was just about exploring possibilities. So never put in the stock market the money you need. So I was always putting the money I didn't need, but when it quadrupled, quintupled, oh, look, I can really increase the quality of my life with stocks. And it has been just the goal. I put it in stocks. If I multiply it, increase the quality of my life, and that's it. And recently, as I am older, have a family, settled down, now I have a few portfolios, and my goal is just to drive them to 1 million, let's say, in 10, 15 years, and I'm on a good path now. So I would add here, Warren Buffett in a recent interview said that for 70 years, he did not have any financial concerns.
Yeah.
So Warren Buffett, he didn't have to think about money, which allowed him to have his mind free. And that's the best way to do rational investing decisions. So, of course, first put your mask on yourself, and then you will be okay. And then you can start exploring. And I would argue here with you, don't put the mask on your kids. Let them find their own way. Because if you put everything served for them, there would be snowflakes or something like that. So give them an education and give them enough so that they don't have to, that they can do anything, but not too much that they don't have to do anything.
Yeah, it's very well known that second generation and third generation wealth just destroys it, don't they? Because they've been sort of handed it to them. Is there anything you're doing with your kids? to teach them? Like, I suppose you're not trying to give them anything, but I imagine you're going to give them something. It's just a bit of protection maybe. But what are you teaching them? How do you teach them? Is there anything that you can sort of pass on to your kids with investing?
So I have now a kid of 4.5 years, and I have been a high school teacher for 5 years. I have been a university lecturer for 3 years. So I've worked with a lot of kids, and the most important things you can teach them is self-confidence, is how to find solutions to the environment around them, because one day you are not going to be around them to give. And the last thing I want with my kid is to see him as a spoiled brat. So my kid will get an education, will get the knowledge, will get the possibilities, will get the traveling, will try to do as much as possible to expand his horizons, his knowledge, his, let's say, life tool skill set. But as for money, he will not inherit whatever I accumulate in life.
I wasn't going to ask you anything really recent, but I'm going to anyway. With Charlie and Warren talking on the sofa with Becky Quick the other day about Robinhood, do you think it's a good idea or a bad idea? You know, Robinhood, the app, and in the UK here we have Free Trade and Trading 212, which are very, very similar. They're unlocking all of that new young money, as it were. And there's a lot of betting and stuff going on. What do you think about that?
It's just gambling. It's terrible because they just think of the business model. The business model is about how to attract as many people to the platform. To attract people, you need to incentivize people with what they want. And what people want, they want fast money. So Robinhood and everything is structured so that people who want fast money, who want those things, get into the things. And you see Robinhood, you need to talk about these stocks that are hot, and nobody explains the investing. And then you said the platforms were called free trading. So you can make money by trading. Nobody talks about investing, because investing, nobody makes any money. Wall Street doesn't make any money on Warren Buffett and Berkshire. So they hate him. But if you go to these new Robinhood stocks that are traded like a zillion times a day, everybody makes money except in the long term, the investor. So the only issue is you have to be smart. And of course, if you get free trades, okay, you can take them, but then you have to be smart not to fall under the influence of the likely 3 times a day emails. Oh, you missed this move, you missed this hot stock, this is the hottest stock, trade this, trade that. And if you can avoid being under the influence of that, then it's okay.
Okay, so we'll get more onto investing, if that's okay, because you talked about 80% of the people that are in investments right now. If there is the mother of all crashes, you know, that Michael Burry style mother of all crashes, if it is coming, you know, a lot of people are sort of preparing for it. I've noticed a lot of people in my comments have been saying, like, I'm holding cash because I'm waiting for the crash to happen. But it could be years, right? It could be years for that to happen. When your stocks go down, inevitably, as the whole market goes down, do you ever get worried yourself? Because you've been through a couple of crashes now. Do you ever get worried yourself? And what keeps you, I don't know, holding? And how strong's your stomach, basically? Is it pretty good?
That's a good question. And so I've been, last year in March, my portfolio crashed, I think 55%. So that's a significant crash. And what did I do? I was buying like crazy. I even took some leverage that was part of my strategy to buy more. And I simply enjoyed the 50% discounts on anything that I already like. And that's also something that people have to understand from investing. Warren Buffett's Berkshire Hathaway, so the holy grail of investing, every 12 years, it crashes 40 to 50%. And that has been the case statistically over the last 50 years. So approximately every 10 to 15 years, it goes down from top tick to bottom tick 50%. Berkshire Hathaway from Warren Buffett. So you cannot avoid these crashes. You just have to accept it as a given. And then, okay, I have 10 years to compound as crazy. When a crash comes, I have to try to find the money and the courage and the stomach to buy more.
We have quite a young audience watching us, sort of the 20s. And these guys do want to take bigger risks. Do you think it's better to take those bigger risks when you're younger, particularly investing, but in anything else, really? Anything else with life? Because I know you took a few risks when you were younger.
So when it comes to investing, one should always avoid risk, because investing is about compounding. And if you're young, you have the biggest investment advantage compared to anyone else, which is time. So Warren Buffett says, you want to be a great investor, start young. So if you're all young, you can start really, really to compound things and start now. And it's incredible what you can do in 20, 30, 50 years. And when it comes to risk, depends how you define risk. Because doing something crazy, gambling, is stupid, where the odds are against you. But if you can find things where the odds are really working for you, then it's the time to really hammer down and work on the risk. But you have to always think about risk and reward. That's investing. And that's something that's very, very difficult, because if you are real value investors, first think about what can go wrong and then think about what can go right.
Don't worry, I am still here. My camera's just turned off. Okay, so a bit of a harder question, because I find this one really hard to answer myself. But broad-based indexes. Everyone says that we should be just picking, even the buff saying it, that we should just be picking up some ETFs, some broad-based index funds, and investing in those and ignoring stocks. Do you ever get tempted to just take that advice and do it yourself? Or I suppose you're already financially free, so you can take a lot more risk and you have a lot more freedom with this. But for someone like myself, would you say buying a broad-based index fund is just where we should be?
No, I think you should think. You should think, okay, if I look at the S&P 500 index, what can I expect as a return? So there is a dividend yield of 2%. Okay, am I happy with 2% per year? There are good businesses, great businesses, best American businesses. There's likely growth ahead of 2-3% alongside inflation. So 2% dividend plus 3%, I'm at a long-term return of 5%. So that's the approach. That's the risk-reward investing approach. What can go wrong? Indexes can always crash 50%. What do I do if it happens? If you're a real investor and say, okay, if indexes crash 50%, I buy more, I keep just setting aside my money over the long term, no matter what, through thick and thin, then you're a great investor. You don't have to spend a minute a day looking at the market. You just automatically invest in index funds, and in 50 years, you will be great. But you also have an option. Now we are at 5%. Okay, if I buy a house with a mortgage, put the down payment, I can maybe get to 10%, because real estate give 4% if I compare my rent. And then it's always about finding opportunities and comparing opportunities. So index funds with the right strategy should be great for the average investor that doesn't want to spend a minute thinking about investing. If you are listening to this podcast 40 minutes in, then you are not that person because you already spent more time that you should spend on investing in stocks in 40 years.
Yeah.
Because index funds, okay, everything is automatic. I don't think about it. I'm happy if it crashes because I can accumulate more. So if you have such a mindset and you're happy with 5 to 7% long term, no matter the ups and downs, then yes. But if you want more, if you want, let's say, less upside, if you start thinking, okay, can I compare, can I find better than 5%? What other options are there? Then I really think I never liked being average in life, so I always strive for better. And if I would have invested 20 years ago, putting my money into index funds, I would be a poor kid still living in a former communist country.
And that's just where I wanted to go. I just wanted to step it up one extra layer, because if anyone's able to answer this question, it's going to be you, because I struggle to answer it myself. When 98% or 90% of market makers or money managers don't beat the market, what makes it possible for someone else to do it? And obviously you're a believer that you can beat the market. Why should we think we can as well?
So when I started investing 20 years ago, my home country index was at 1,200 points. That was 20 years ago. Today, the index is at 2,000 points. So it didn't even double over 20 years. So that's terrible performance. So if I would have invested in indexes, I would be a terrible investor, because there is the S&P 500 that did remarkably well. But there are other 500 indices that also might not do, will certainly not do as well. So my idea is, I don't care. Stop thinking about the market. Start thinking about what kind of return for the relevant risk is good for you. If somebody would tell me that I can get real returns of 15% per year for the next 10 years, but that the market might do 20% returns, I would sign immediately. I'm happy with 15% real returns over 10 years. That's my target.
Yeah.
If the market does 20, great. I'm happy for all the other richness in the world. Everybody will be richer. Great. For me, it's always about what you own, not about the market. I really, really don't care about stock prices, because I know stock prices can go up and down all the time. And I know that there is a statistical chance that all the indices, if interest rates go up, the S&P 500 or the FTSE or everything will be 70% down in 7 years. There is a possibility that that can happen. There you have your crash title and thumbnail. But that can really happen. So one should really think, okay, what can happen and how does that fit me personally? You have your financial goals, you have spouses, you have your kids, you have your plans in life, and then you have to structure things. Okay, how can I structure my financial life so that it gives more value to me? Who cares about what the market in Australia or the market in the US does? You care about your financial life, and you have to reach your financial goals, and you have to find the investments that will lead you there. If your goal is outperforming the market, yes, the market can go down 70%, you can go down 60%, but I don't think you would be happy that you outperform the market. So it's really about what you own, how you own it, why you own it, what do you get from that investment. And to keep talking about Buffett, he says, whatever you should buy it, and imagine that the stock market would close for 10 years. Mm-hmm. And that's such an overused quote, but it's so powerful. And actually, no one goes deep enough to think about it. Mm-hmm. When you buy something, try to think, okay, am I happy owning this? Really, if tomorrow the government says, okay, we're going to close down the stock market for 10 years because we are pissed off by these Robinhood traders and everything, would I be happy owning that business for 10 years? And that's a key question to ask yourself before buying anything.